Many retirees know that they have the ability to split certain types of income with their spouse on their tax return. For example, they can split eligible pension income and they can split RRIF withdrawals provided that the account holder is over the age of 65. But many retirees are surprised to learn that technically you cannot split your Canada Pension Plan benefits with your spouse on your tax return. You can, however, share your Canada Pension Plan benefits. There's a very specific distinction, and in this video, I'm going to talk about the difference between income splitting in retirement and CPP pension sharing. I'm going to talk about how the CPP pension sharing formula works, and I'm going to talk about situations where it may make sense for a retiree couple to share their Canada Pension Plan benefits in retirement. And if we haven't met yet, my name is Mark Walhout. I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so you're alerted when new videos are posted. CPP sharing allows married or common law couples to share their Canada Pension Plan benefits with the goal of lowering their household tax bill. The conditions for CPP sharing exists if number one, if one member of the couple is in a higher marginal tax bracket than the other member of the couple, and number two, if their CPP benefit is higher than the other member of the couple. This is surprising to many retirees, but CPP pension sharing does not result in a 50-50 sharing of CPP pensions. In the example I'm about to illustrate, I'm going to talk about how CPP pension sharing works for our sample retiree couple, Jack and Jill. So I'm going to go ahead and share my screen. I'm going to introduce you to Jack and Jill. So Jack is 65 years old. His monthly Canada Pension Plan benefit is $500. Jill is 68. She's 3 years older than Jack, and her monthly CPP pension is $1,000. They've lived together for 40 years. They are both in receipt of the Canada Pension Plan benefit, and they both began taking it at their respective age 65. They both receive $700 per month in old age security, and they're both withdrawing $30,000 per year, respectively, from their RRIF accounts. So their total income on their tax returns for 2023, before we talk about CPP pension sharing, for Jack will be $44,400. For Jill, it will be $50,400. And their total tax bill, I estimate at $10,830. And if you want to get access to the sample tax returns that I use to sort of create this scenario, I've linked to them in the show notes using the tax calculator from taxtips.ca, which is a fantastic calculator if you want to try out different tax scenarios. That's where I go to test out different scenarios. So I welcome you to go ahead and check it out. So this is Jack and Jill's current situation as far as it relates to their Canada Pension Plan and their current tax bill before CPP sharing. So in order to figure out how the CPP pension sharing calculation works, we're going to start with some sort of base level understanding of what our contribution period is and how it's calculated. So for every Canada Pension Plan annuitant, our contribution period or our contributory period is calculated from when we turn 18 to when we either begin taking the Canada Pension Plan benefit or turn age 70 or pass away. Those are really that's like the bulk or the expanse of the CPP contributory period. The joint contributory period is sort of a smaller period of time whereby you and your spouse are living together. So it's like a portion of that total contributory period, and it's that smaller set that's used to figure out how much of your Canada Pension Plan benefits as a couple can be shared with each other to accomplish that income splitting that we talked about in the beginning of the video. So this can be a bit complicated. And what I did is I put together a diagram that I hope will help you understand through an illustration how this period is calculated. So what we're looking at here is a timeline, and it starts at when Jill turns age 18. So that's sort of the beginning of the clock for Jill's contributory period. And the beginning of Jack's contributory period is at age 18. As far as the joint contributory period, that starts when the couple is either married or begins living together, and it ends when the second member of the couple begins collecting their Canada Pension Plan benefit. And remember that in our example, both Jack and Jill began taking their Canada Pension Plan benefit at age 65, and that's denoted here. Jill took it a little bit earlier than Jack. But for the purposes of calculating how much of their respective candidate pension plan benefits can be shared, that period is measured by the time that they started living together, and it ended when the second of the two members of the couple began taking their candidate pension plans. So their joint contributory period in this case is 40 years. That number is then divided by the period of time between when the eldest of the couple turned 18, and that in this case it's Jill, and then when the second member of the couple began taking their CPP. So that's the total contributory period divided by the joint contributory period. What that nets out to mean is that 80%, so we take 40 years and divide it by 50, so 40 here divided by 50, that works out to 80% of their collective Canada pension plan benefits can be shared. And when we do that calculation, the result is that Jack's CPP was $500. Now, after CPP pension sharing, his CPP benefit will be $700. Jill's CPP benefit will drop. It was $1,000. Now, after sharing, it's going to be $800. So what we've done is we sort of evened out the pools of CPP pension income between Jack and Jill. The net impact when we reran their tax scenario or reran their tax projection, in the previous scenario before CPP pension sharing, their collective tax bill for 2023 would have been $10,830. Now that we've moved some income from Jill over to Jack, their net income bill, or the income bill after we made that change, is $10,632 for just under $200 of income tax savings by implementing CPP pension sharing. So not a huge amount of difference in this case, but a difference nonetheless. That's $200 of additional taxes that wouldn't have to be paid after CPP pension sharing in this scenario. Hopefully you found this video on CPP pension sharing to be helpful. I've included a number of resources in the description section, including the before and after tax calculations for Jack and Jill, our hypothetical couple, the before CPP pension sharing and after CPP pension sharing. I've also included a link to the government site that will give you more information on how to apply for CPP pension sharing in your situation. But to sort of put a cap on today's video, here are really the three criteria that you can apply against your situation to determine whether CPP pension sharing might make sense for you. The first is that you and your spousal couple, or you and your spouse, the first is that you and your spouse both need to be collecting the CPP benefit. The second is that one member of the couple needs to have a higher CPP benefit than the other member of the couple. And this is always the case. There's never two identical CPP benefit amounts for two members of a couple. But the big key here is that the member of the couple in receipt of the higher CPP benefit needs also, or should also, be in a higher marginal tax bracket in order that CPP pension sharing will have a net positive impact on your year-to-year income tax bill. Again, thanks for watching this video all the way to the end. I hope that you found it helpful. Give it a thumbs up if you like it. There's a number of other resources in the description section below, including my weekly newsletter called Retirement Roundup, and a couple of quizzes and resources around how much you need to retire, and my retirement spending planner. You're welcome to those resources below. Again, thanks for watching this all the way to the end, and I'll speak with you next week. Take care.